Welcome back to Money Guide UK. I'm host Naim, and if you have been paying attention to the latest news, you would have likely come across the headlines: house prices reducing, mortgage rates reaching levels that we haven't witnessed in the past over a decade. However, what is genuinely driving this unexpected surge? Is it merely inflationary factors, Brexit consequences, or is there something even bigger at play? Today, we are delving deep into every single element, eliminating any jargon and providing you with nothing but straightforward, actionable information. Stay tuned by staying until the very end, because we will be diving closely into what this development means for you, whether you happen to be a first-time buyer, a loyal homeowner, or even contemplating the idea of selling your property. To start off, do not hesitate to hit that subscribe button and quickly add the bell icon to your favorites list in order to stay updated with our weekly insightful dives into the dynamics of UK personal finance and property. Let's start with the big one. Why are mortgage rates going up so fast? The short answer is the Bank of England's base rate. Since they've raised it from 0.1% to current rate. That's number consecutive hikes. But why are they doing this? 1. Taming inflation. When prices rise across the economy, from food to fuel, the bank uses higher interest rates to slow spending. If borrowing costs go up, people tend to spend less, which should bring inflation back down to their 2% target. UK inflation peaked at figure percent in month year, and while it's falling now, it's still above target. 2. Global economic pressures. It's not just a UK issue. Central banks around the world, like the US Federal Reserve and European Central Bank, have also been raising rates. This affects how international investors view UK assets, so the bank has to keep pace to maintain confidence in the pound. 3. Post-mini-budget turmoil. You'll remember the September year mini-budget. The sudden announcement of unfunded tax cuts sent financial markets into chaos. Lenders pulled hundreds of mortgage products overnight, and rates jumped sharply as investors demanded higher returns to lend to the UK. While stability has returned, some of those rate increases have stuck around. Now let's turn to house prices. According to the Office for National Statistics, average UK house prices have fallen by figure percent since their peak in month year. Here's why that's happening. 1. Affordability has hit a wall. Higher mortgage rates mean monthly repayments have skyrocketed. Let's take an example. A £300,000 mortgage over 25 years at 2% would cost around £1,280 a month. At 6%, that jumps to over £1,900. That's an extra £620 every single month. Many buyers simply can't stretch to those payments, so demand drops and prices follow. 2. Uncertainty deters buyers and sellers. When people don't know what's next for interest rates, jobs, or the economy, they hold off on making big decisions. Sellers are reluctant to put their homes on the market if they think prices might fall further, and buyers are waiting to see if they can get a better deal later. This slowdown in activity puts downward pressure on prices. 3. Changes to lending rules. After the 2008 financial crisis, regulators introduced stricter checks to make sure borrowers can afford their mortgages even if rates go up. Lenders now have to stress test applicants at rates well above the one they're applying for. This means some people who could have borrowed a few years ago can't get as much now, limiting how much they can offer for a home. 4. Regional variations. It's not uniform across the UK. Prices in London and the South East, which saw the biggest increases in recent years, are falling faster than in other regions. Areas with lower average incomes are also feeling more pressure, as even small rate hikes have a bigger impact on household budgets. It's important to understand that mortgage rates and house prices aren't working in isolation. They're feeding into each other. When rates go up, demand drops, so prices fall. But falling prices can also make lenders more cautious, leading them to keep rates higher to manage risk. It's a cycle that's hard to break. There are other factors at play too. Supply and demand imbalance. The UK has had a shortage of homes for decades, which has kept prices high. But while supply is still low, demand has fallen even faster, so the gap is narrowing for now. Cost of living crisis. With food, energy, and utility bills eating up more of people's income, there's less money left for housing costs. Even those who could afford higher mortgage payments are choosing to save more or cut back elsewhere. Rental market pressure. High mortgage rates are also affecting landlords. Many are facing higher repayments or can't afford to buy new properties. This means fewer homes available to rent, pushing rents up even more. Some renters are now stuck in a cycle where they can't save for a deposit because of high rents, while others are having to move back in with family. So what does all this mean if you're in the property market? If you're a first-time buyer, higher rates make it harder to get on the ladder, but falling prices could mean you need a smaller deposit. Look into government schemes like Help to Buy or shared ownership, and consider a longer fixed term to lock in a rate if you can afford it. If you're a homeowner, if you're on a fixed rate that's ending soon, start shopping around for a new deal now. Don't wait until the last minute. If you're struggling with repayments, talk to your lender immediately. They have to offer support options like extending your term or switching to interest only for a short time. If you're thinking of selling, be realistic about your asking price. Homes that are priced competitively are still selling. Consider waiting if you don't need to move urgently, but if you do, work with an experienced local estate agent who knows the current market. If you're an investor, do your research. Areas with strong rental demand and good transport links are still viable. But make sure your numbers add up with higher mortgage costs and potential changes to tax rules. To sum up, the key point is that mortgage rates are on the rise primarily due to efforts aimed at controlling inflation and addressing global economic challenges simultaneously, while house prices are also experiencing a notable decline, largely owing to reduced affordability and growing uncertainty in the market. In the current market situation, it is noteworthy that market correction is occurring for a substantial period of rapid growth, and the conditions are challenging at present. However, these circumstances could also provide opportunities for those who have the necessary readiness. This is a guideline with available mortgage rate comparison tools and an insight into regional house price trends, all available at the link provided in the description below. The subsequent week will focus on advice on saving for a deposit in the context of today's escalating cost of living crisis, so make certain you unsubscribe. Should you have any additional questions about the topic addressed today, feel free to leave them in the comments section, and we'll do our utmost to respond to them all promptly. We hope you found our Money Guide UK content useful. Stay well informed with your financial choices.